Hey everyone, when we think of the perfect dividend growth investing stock, I'm thinking of a company that can consistently give us capital appreciation, can consistently deliver good quarterly and annually results, perform well in recessions, and of course, raise that dividend considerably year after year while not putting a strain on the overall company for them to be able to continue to expand. This is a company that I don't need to babysit because I know that they're going to be smart with my money and how they operate their business, and over time, they're going to make us rich. When this company recently raised its dividend yet again considerably, I realized this is actually the perfect dividend growth investing company to own practically forever. The stock I'm talking about, of course, is the healthcare company UnitedHealth Group. Their revenue of $242 billion in 2019 was bigger than the entire GDP of the countries of Austria, Norway, and Israel. We're going to talk about their business model, financials, and everyone's favorite part, how much of a golden dividend cash cow that they are. These videos take a lot of time for me to produce and research, so all I ask from you in return is a like and subscribe to the channel so I know to put out more videos. United Healthcare Group is one of the largest healthcare insurance and healthcare service providers in the United States. Their revenues come from the premiums they charge for their insurance, fees for their consulting, administrative, and technology services, as well as sale of their healthcare related products. UNH's large network includes 1.4 million physicians and other healthcare professionals at more than 6,500 different hospitals, though they are subject to extensive government regulation as a result. Many people use UNH through their employee-sponsored plan, though this may take a small dip if the US unemployment rate remains relatively high here, hovering just over 10%. UnitedHealth's customer base just continues to expand as they served 49 million people in 2019, which is up from 46 million people in 2015. UNH is a global company, serving more than 8 million people outside of the US with medical and dental benefits. Their Optum segment is actually their fastest growing segment. Optum Rx manages more than 1 billion prescriptions annually to over 65 million people in the US. Optum helps finance medical activities as well as driving data mining with their claims and software across the healthcare industry. Although the biggest risk that people may always point out for this company is, what if healthcare in America changes and private insurance companies become obsolete? This isn't some new idea, right? It wasn't Bernie Sanders coming out and suggesting a universal healthcare for the first time. This is something that's been talked about for decades. But that's about it. It's one of those subjects that gets talked about every election cycle, but not much really changes over the years. If you look back at what was talked about 50 years ago, you'll see that it's a lot of parallels and commonalities with what's going on even today in 2020. The reality is that there's no way that the wealthy politicians who make the laws will go to the same hospital as us common folks. So there will always be private insurance options. Plus, you know the insurance companies have plenty of money to swing politicians into whatever is in the best interest of their company. I'm not saying if that's right or wrong. I'm just saying these guys have huge pockets. Regardless of which party gets elected, it will actually be good news for UNH. The Affordable Care Act benefited UNH greatly as 28% of their revenue currently comes from Medicare. Lower drug prices and generic drug prices declining could also help UNH's expenses. Since Trump has taken office, UNH has roared 80% in stock price, so I don't think you have to worry if he's bad news, at least not for this company at least. While other companies are struggling to determine how they can make up for losses of revenue or stay in business, UNH has actually been able to grow their revenues in their Medicare, Optum, and overall revenues for Q1 2020. Which gets me into my next point, and that is that this is not a cyclical industry or company. People will always need health insurance. In fact, people have this really high on their list of bills to pay each month. You quite literally won't survive very long without health insurance in America. This is further supported that UNH didn't need to cut its outlook during its last earnings call, actually maintaining their full-year earnings per share outlook for 2020. So guys, long story short, they have monthly premiums across many different segments that are growing quite considerably as they offer insurance to elder folks in Medicare and retirement. Plus they have their employer-sponsored ones or individual ones, state-sponsored ones, and all their international coverage. Insurance is a very profitable company as long as everyone doesn't just happen to get sick or need medical attention all at once. It's designed where if a few people are in need every month or so, or every week, a small percentage of them need some sort of care or don't need to seek any medical attention, they can subsidize for those people. That's how insurance works. UNH may shine in their business model, but I think they set the bar even higher in their financials. If you're ever looking for what a well-run company's financial statements are supposed to look like, use UNH as a model. We know that UnitedHealth is a juggernaut of a company, coming in at a market cap of just under $300 billion. It was hard to even find a competitor for UNH because they're really in a league of their own. For this comparison example, I'll choose CVS, which includes Aetna as a subsidiary of their main competitor, but others include Cigna and Anthem. So when we look at market cap, UNH is 3 times as big as CVS. Again, there's really no comparison here. UNH is one of the largest companies in the world and doesn't have any plans of slowing down in terms of its growth. Next, when we look at forward PE, I like to look at forward PE ratio since the market is trying to predict the future, not necessarily the past. Forward PE will take the share price by the estimated future earnings of the company rather than just the past 12 months. Here we see that CVS has a pretty low PE ratio, so it could actually be a better fair value than UNH, though that's really subjective. Revenue growth over the last 5 years is very important as we want to make sure our companies are growing and expanding. Here we can see UNH went from $157 billion in revenue in 2015 to $242 billion last year, and there is absolutely no signs of slowing down. As more and more people enter the United States, they're going to need health insurance, and UNH is one of the biggest players in this industry, so expect more and more revenues and premiums every year. Free cash flow numbers have doubled to $16 billion. Net income has nearly tripled to just under $14 billion just in the past 5 years, guys. This is absolutely amazing, and these are all going in the right direction, which is most important. Next, when we look at free cash flow, this is important because there's all sorts of accounting tricks to lower or decrease net income. Free cash flow will tell us exactly how much money the company made from its operations minus its operating expenses and capital expenditures, which is basically the company making improvements with its infrastructure, such as buying, maintaining, and improving assets. We see that CVS here has had great revenue growth of 67% in the last 5 years, but remember, they are a much smaller company, and they've also had some mergers and acquisitions that may throw their number off. So still, both of them did phenomenal here. UNH, 54% revenue growth in the last 5 years. That's very respectable and very good compared to CVS's 67%. So cash on hand, this is money that can be available in a quick period of time for the company to use rather than having to sell their assets. So both companies, again, in this comparison, do very well, and this is very important in a time like this when companies need to be able to be flexible. Having cash on hand is important to be able to pay off expenses or capitalize on opportunities for acquisitions. Both UNH and CVS have solid cash positions here at $11 billion and $8 billion respectively. So long-term debt, this can be credit lines, bank loans, bonds with obligations, and maturities greater than 1 year. So companies having to pay interest on these obligations can really hinder their growth as they may have been otherwise able to use that money to grow their business. We see here that UNH has about $37 billion, which it can easily cover with their total assets being around $176 billion. CVS here has a huge red flag because for their Aetna acquisition, they now have a larger long-term debt position than their entire market cap. They're really going to have to hope that that merger pays off so that they can start paying back that interest and principal. The debt to equity ratio will show us the percent of company financing that comes from creditors and investors versus wholly owned. A decent ratio is around 1 to 1.5, but that's going to depend on the industry. UNH has just a 0.6 ratio, which means they could actually probably use more financing and leveraging, but I think I'd rather actually be too under leveraged than too over leveraged. CVS is pretty solid here at 1.29. Current ratio will give us an indication if a firm has enough resources to meet its short-term obligations. Usually a ratio between 1.2 and 2 is solid here. UNH's may look low at just 0.75, but I looked at what it was trading at historically, and it's actually just right in line, so I wouldn't be too concerned. CVS at 0.99, that's not too bad either. So return on equity, this is really important as well because it measures how effectively management is using a company's assets to create profits. Calculated by taking the net income divided by average shareholders' equity, return on equity is typically around 15 to 20% are considered good. So we can see here that UNH again slams this one out of the park, 23.96%, almost a 24% return on equity. CVS at 11.5, that's about average. UNH is really in the upper tier of stocks here with that crazy return on equity. So UNH is doing a really good job at making us money. Basically, for every dollar we invest with them, we get a 24-cent return compared to CVS, which gives us just an 11-cent return back. Next, when we look at years of consecutive dividend growth, we can see that UNH, it's not a dividend aristocrat, but it's definitely going to be a dividend challenger here now with 11 years of straight increased dividends. And then CVS has not raised its dividend in a couple of years now. UNH gets another victory here with its 11 straight years of dividend increases. We took a very quick look at UNH's financials. There's a whole lot of other financial statements and analysis that we can do, but this was just a quick crash course, and there's really just no red flags here for me. If anything, it's a very strong balance sheet. It has increasing revenues and free cash flow. They are all big positives. Now let's talk about total return and dividend growth, another huge plus for UnitedHealth. This is where you guys might really see how powerful and perfect that UnitedHealth is to be that perfect dividend growth investing stock. Okay, now we're going to track UNH and the S&P 500 over the last 10 years or so. So starting in July of 2010, we had UNH trading for about $30. Man, I wish I can go back in time and buy lots of shares of UNH, as well as a lot of other companies. So 10 years ago, it was trading for only $30, and we only got paid 50 cents for the whole year of owning them, which gives us a very measly yield on cost of 1.66%. Now imagine we did absolutely nothing but just hold on to our shares of UNH. Now 10 years later, we would have a share price of a little over $300, and now UNH pays us over $5 in dividends every year. That is just phenomenal. We did absolutely nothing except have our shares work for us, have those compounds year after year, and now we have a ridiculous yield on cost of about 17%, as well as all the capital appreciation we've gotten here. And the scary part is that number will only continue to go up because UNH has plenty of money to continue to raise their dividend, which they're gonna do. I can easily see this become a future dividend aristocrat. And this is the true power of dividend growth investing right here. And this is why I was so happy to talk about UNH. It is the perfect dividend growth investing stock. Sure, that dividend yield is a measly 1.63% right now, and it's not very high. But guys, say it with me. All we have to do is buy, stash, and collect cash. That yield will one day grow very, very big, getting that preferential tax treatment as well, because dividends do not get taxed like that ordinary income you make working your 9-to-5 job. UNH has also returned an out-of-this-world average annual return of nearly 27.5% every year this past decade, which is 2 times better than the S&P 500 return. Of course, past performance isn't indicative of future performance, but come on guys, healthcare insurance is not going anywhere, and UNH is so much bigger than its competitors that I expect big things from them moving forward. I don't need to babysit this. I just need to buy my shares, hold on to them, and keep collecting that cash. and I will definitely be adding more. You can see I only own 4 shares, market value of a little over $1,200. I have a pretty good average cost with these guys, 24.8% return. These videos take a lot of time to put together, so please help support the channel by leaving a like if you really enjoyed this content. Leave a comment if you can think of any other great dividend growth investing companies, and if you like UNH, and what you thought of the video, and subscribe to the channel as well.